My base case has been a period of correction and consolidation. And then I think the next big move was actually higher. My view has been that it's likely to be sort of like, when gold hit 3,000 and consolidated for a while, or even more in 2020 when it hit 2,000 and consolidated for 3 years before the next big breakout higher. Why gold had to keep going straight on to 10,000 bucks an ounce or whatever it was. Though back then we thought that 5,000 would be the nirvana. And then markets did otherwise.
So I think gold is potentially tuning to do the same thing. Now, do I think it is going to go sideways for 14 years? I tend to think not. I think the market could have a very big correction, stabilize, and then potentially rocket higher and head up to $8,500 per ounce. That would be the best case scenario, right? A quick pullback, it finds stability, something in the economy or currency blows up, and gold goes through the roof.
Gold's recent pullback has sparked debate across the precious metals market, but many investors believe the broader bull trend remains intact. Short-term volatility may continue, yet the long-term drivers supporting higher prices have not disappeared. Market participants are closely watching whether this correction develops into a deeper decline or simply becomes another pause before the next major advance. Lobo Tiggre, a veteran resource investor known for his focus on commodities and mining markets, and Chris Vermeulen, a respected technical analyst recognized for identifying major market trends, argue that current price action should be viewed within the context of a larger cycle rather than as a definitive end to the bull market. The current setup resembles previous periods when gold reached major milestones, then consolidated before moving significantly higher. Central bank buying, persistent currency debasement, and long-term inflation concerns continue to support the precious metals sector. While a sizable correction cannot be ruled out, the broader structure suggests that stability could eventually lead to another powerful rally. If economic stress intensifies or confidence in fiat currencies weakens further, gold may once again attract substantial capital flows and challenge significantly higher price targets. Now, we present the clips from their interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
If you treat January of this year like a peak in gold, and you compare it to 2011, it looks very similar from the shape of the ramp up and the dead count bounce afterwards, and then the second bounce and then the continuing downwards. It's scarily similar. 1980 is a little bit different, but roughly similar. All three of them echo in alarming ways. Now, I'm not saying that proves, therefore, that this is an interim peak and we're going into a bear market, but I do think it's a mistake for gold bulls to just dismiss that and say it's impossible. They did that in 2011 at great risk. So the question is, what am I looking for? I would like to see a divergence in those charts. Like the other idea, and what had been my base case actually going into this, my base case has never been calling January a peak and saying we're going into a bear market. My base case has been a period of correction and consolidation. And then I think the next big move was actually higher because of the reasons that I'm sure Mario would agree with, the central bank participation, the money debasement, all that stuff going on. I think everybody in the audience probably is on the same page there. Like all those fundamental reasons haven't gone away. So my view has been that it's likely to be sort of like, when gold hit 3,000 and consolidated for a while, or even more in 2020 when it hit 2,000 and consolidated for 3 years before the next big breakout higher. That's been what I've been expecting ever since that correction from the vertical peak over 5,500. But the longer it looks like 2011, the more I have to say it behooves us to be cautious about, saying, no, it's got to recover anytime soon. So that's what I would look for. I would look for divergence in those charts. As long as gold continues, fluctuating downwards, the more that elevates the risk of a mid-70s style correction or a post-2011 style correction, which, by the way, is roughly around 50% down. And we're halfway there. If we did get to a 50% drawdown, then at that point, I wouldn't even care about the charts. To me, that would be oversold. That would be a no-brainer. And by the way, so 50% down is high 2000s. It's sub $3,000 gold. If we were so lucky as buyers who are cashed up to see sub $3,000 gold, I would be deploying with both hands or all four paws, as the case may be for a wolf. I'd have a garage sale. I'd sell some blood. I mean, to me, that would be like gold at 700 in 2008. Just a no-brainer of a buying opportunity. Since I'm cash rich right now, I could say that, I would look forward to that for all our long-suffering gold bugs who are still massively long. I can't say that I wish for them to suffer that fate. I'm just saying I'm prepared either way. But actually, my base case is not that that's likely to happen. And so my answer is I'm looking for a divergence in those charts. I'm looking for some recovery here. I would like to see gold show strength between 4,000 and 5,000. Even if that does that for a year or two, that would give me confidence that the next big move really will be higher. But if it keeps breaking down here as we go forward, it starts looking more like an interim peak like the last ones.
The precious metal space had these. It depends on how they move up, right? When we look at these charts, when they start to go real parabolic, they don't always have to come straight back down, but in most cases, they come back down for at least half of the move. That tends to be the big scenario. We've seen this over and over again. When it becomes this euphoric spike move, we see a very sharp drop. You'll notice like this spike from back here in the 80s, it didn't come all the way back down, but it came back down a very good chunk of it. Like if you were to just box the low and the high end, it came back, well, a huge chunk of it and some. Emotional moves are usually wiped out. So whoever gets in late and buys into the feeding frenzy move, usually the market's going to come back down to that price and then usually go a little bit below it. And it's the same we're probably going to see with SpaceX. I've done different IPOs over my life. I've done a lot of different company placements, private placements. And it's funny, you get in and the stock price goes ballistic and on paper you've made a fortune. But by the time you can sell those shares, the prices come back down and is trading below the price you actually got in because you're not allowed to sell it. And so that's kind of what these spikes do. The first part of the move is legit. It's a real accumulation and stuff. The last part of the move, the parabolic spike, is the emotional feeding frenzy, the FOMO. And that FOMO section is usually wiped out. And then it goes a little bit below it to turn, even the early people who got in into a loss until they can't take it. So spikes are dangerous. There's no doubt. You don't know where the peak is. And when it does peak, it drops quickly. And so you have to be very aware. Very small positions should be traded if you're ever trading a spike. The gold chart is pointing to a pullback to about 30 from where it is right now. The pullback is about 3,600 to about 3,300. So it has about a maximum kind of 17% downside range from where it is. So, and that's why I've always liked gold. Usually when I'm putting in big positions or even short-term trading positions, I'll naturally navigate to gold versus silver because I find gold is very predictable. I have a much higher win rate with gold. It moves slower, but I trust it so I can put more money to work. So a lot of people don't understand position sizing and things like that. People are like, oh, you need silver to make more money. I'm like, well, if silver backfires, you put a lot of money in it, you blow your account up and there's a higher chance of you suffering. I like slow, consistent moving things where I can dump in a lot more money and watch my whole section of that portfolio climb in a consistent rate in a much more controlled manner. So that's why I really like gold as both a long-term investment and even short-term trades. The discretionary side trades we've done with gold, where we played a couple of these big breakouts as extra bonus trades, we're just in gold, right? Very simple, very low risk, and a very high probability type of trade.
A key concern among analysts is the resemblance between recent gold price behavior and historical market peaks. Some chart patterns resemble previous cycles, including the periods following major highs in 1980 and 2011. These comparisons have encouraged investors to remain cautious rather than assume prices can only move upward. At the same time, the bearish interpretation is far from certain. Long-term fundamentals remain considerably stronger than in many previous cycles, and institutional demand continues to provide support. Instead of a prolonged bear market, the more likely scenario may involve an extended period of correction and consolidation. Such a phase could help reset sentiment, reduce speculative excess, and create the foundation for a healthier advance later. Until clearer confirmation emerges, both bullish and bearish possibilities remain on the table, making risk management increasingly important. Now, let's get back to the interview.
The market has two ways to try to get everybody out. The first one is if the market, the saying is if the market can't shake you out, it will wait you out. So it will drop significantly, usually very quickly. Like these first sections, right? These first sections are going to try to get you out, depending on what you consider the first section. The market will try to shake you out. If it doesn't get you out because you're like, no freaking way, gold is going to the moon and the economies, the world's falling apart. I mean, gold always has had the perfect story. Every year gets even better. But if it doesn't shake you out, then it will wait you out. Eventually, you give up. You waste all of this time, right? Some decades in some cases with no return and watching your money go down. And gold costs money to hold. So I think gold is potentially tuning to do the same thing. Now, do I think it is going to go sideways for 14 years? I tend to think not. I think the market could have a very big correction, stabilize, and then potentially rocket higher and head up to $8,500 per ounce. That would be the best case scenario, right? A quick pullback, it finds stability, something in the economy or currency blows up and gold goes through the roof. Although I don't really think deep down that's what everybody wants, because obviously if gold shoots higher and something breaks, it's going to affect all of our lives and businesses in probably a much worse way than watching your account go up 50 or 100%. I really things still come back down to we want a really good life. So people are praying for crazy high gold pricing. I'm like, it will mean life probably sucks. We're going to have some serious, even more serious issues than we have now. So gold is in the shakeout phase right now. And then the question is, how long is it going to wait you out? And that's why, like, we moved out of gold when it broke over 5,000. We moved out of silver at $111. And now we're letting it figure itself out, because I don't believe in holding something for 20, 30 years or even 14 years. I don't even believe in holding something for a year or two, waiting for it to turn around. A year or two, that money can go to work somewhere else and make us return on our capital versus riding it down and stuff. So that is where I stand apart, is I don't fall in love with assets. I only love them when we're long. And the second they show signs that they're rolling over, we could care less. We just step aside, go find something else. And so that is the part we're in now. The gold, probably, if it hasn't shaken you out, you're going to hold on to it. You're going to have it as a dead investment for years until you eventually say, forget, I'm moving on, put me into something else. Or you just kind of waste those years, right, with no return until it skyrockets. And over time, you'll be right. The question is, what are you going to do with that money? Or do you want that money working for you over the next 2 or 3 years or 10 years, right?
In 2008, the thesis, the underlying thesis for why gold would, should do well even in a crisis, I understood that, but it was very painful, and I rode the wave down in 2008. And then in 2011, we had the GFC was not that far in the rearview mirror. All the arguments, it sounded a lot like today, very convincing arguments for why gold had to keep going straight on to $10,000 an ounce or whatever it was. Though back then we thought that 5,000 would be the nirvana. And then markets did otherwise. This time things went vertical, and I said, you know what? I'm going to take some profits here. I'm going to not just pill around with a little bit of profits. I'm going to book a win. And I got to tell you, my feelings now on the downside are completely different from what they were in 2008 or 2011, 12, 13, 14, 15, right? The equanimity one feels of having realized gains, not paper gains, but realized gains. This is not rocket science, but I just want to stress this, not in the I told you so sense, but in the, folks, the goal here is to make money. And if you've made money on one bet and you're willing to wait for the next opportunity to buy low again, it works out really well. And this stress levels are so much better. So the takeaway is when the party is on, prices are going vertical, and everybody's saying, yes, it has to just go straight to the moon. Beware the Kool-Aid. You're not a bear if you decide to go ahead and book some wins. And it makes all the difference. Right now, I could be buying those very same stocks I sold, right, at much lower levels. And watch, rinse, repeating, and keep going upwards. So I'm a long-term bull. Nothing has changed. The reality of having booked some profits, it's not about I told you so. It's about having the money to take advantage of the next opportunity to buy low, which might be soon in our favored metals, or maybe it'll be something else. We'll see. Bullion is not a speculation or even investment. I really see it as savings or an insurance fund, if you will. I have literally used bullion in that way in my life, like financial meltdown, that last resort of liquidity. I have used that. And I've also used it in the other sense, a positive sense of a once in a lifetime buying opportunity. Don't get distracted by talk about, what the market might do and what interest rates might do and all this stuff. In terms of, my speculations as a stock speculator, that's a completely different thing, from my stacks. And, like Mario says, it goes on sale. There's a big drawdown. That's a good day to add to my stacks.
The broader outlook for gold and silver continues to revolve around monetary policy, government debt expansion, and the ongoing erosion of purchasing power. These structural forces have not disappeared, which is why many investors remain constructive on precious metals despite recent weakness. A temporary decline may shake confidence, but long-term trends often develop through multiple corrections before reaching their ultimate destination. If prices establish a durable base after the current consolidation phase, the next leg higher could be substantial. Some analysts believe a powerful catalyst such as financial instability, currency concerns, or a broader economic slowdown could reignite demand for safe haven assets. In that environment, gold could eventually revisit aggressive upside targets, including projections approaching $8,500 per ounce. Silver may also benefit from renewed investment demand alongside its growing industrial importance. Rather than focusing exclusively on short-term fluctuations, investors are increasingly watching the bigger picture. The combination of central bank accumulation, persistent debt growth, and ongoing monetary expansion suggests that precious metals remain positioned to play a significant role in the years ahead, even if the path forward includes periods of volatility and uncertainty. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.